How to build business credit from scratch in 2025. 1. Register a legitimate business. Establishing business credit begins with legal formation. A sole proprietorship, while easy to set up, lacks separation between the individual and the entity, an audit invitation with frosting. The preferred structure for credibility and liability shielding is the limited liability company, LLC, or corporation. Incorporation at the state level ensures visibility in public records, a prerequisite for data collection by credit bureaus. Entities should avoid ambiguous names and mismatched documentation across registrations, bank accounts, and IRS filings. Consistency, apparently, is not just for skincare routines. Businesses operating under a trade name must file a doing business as DBA registration, lest the credit bureaus think the company exists only in theory. Footnote: Legal entity registration is the foundation for business creditworthiness and regulatory recognition. 2. Obtain an employer identification number, EIN. The EIN is the Social Security number's more corporate, less emotional cousin. Assigned by the Internal Revenue Service, IRS, this 9-digit identifier is mandatory for opening business bank accounts, filing taxes, and applying for credit products. Applications can be completed instantly online or via Form SS4 by fax or mail, for those who still enjoy the thrill of waiting. The EIN separates the business from its owner, legally and financially. Failure to acquire one is equivalent to operating with a blindfold in a maze, except the walls are made of IRS agents. Footnote: The EIN is required to establish financial independence between a business and its owner. 3. Open a business bank account. To build credit, businesses must transact through accounts bearing their own name, not their owner's debit card from college. A business checking account not only legitimizes operations but becomes the central hub for financial activity. Lenders and bureaus monitor cash flow, average balances, and deposits, all of which feed into risk algorithms. A separate account streamlines accounting, simplifies tax compliance, and prevents the IRS from assuming your Uber Eats charges are deductible. Most banks offer business products, but selecting one that integrates well with future financing goals is prudent. Footnote: A dedicated business bank account ensures operational legitimacy and transactional traceability. 4. Apply for a business credit card. Once a bank account is established, the next move is acquiring a business credit card, ideally from the same institution. Banks favor familiarity, and approving a cardholder they already observe is less risky. The credit card should align with operational needs, cashback for service firms, travel rewards for consultants, or spending multipliers for ad-heavy startups. Credit utilization should remain below 30%, ideally below 10%, to maintain a strong credit profile. High utilization signals financial distress, low utilization signals competence, or restraint, both equally rare in startups. Footnote: A business credit card facilitates credit building and cash flow management under structured terms. 5. Monitor business credit scores. Business credit monitoring isn't just for the paranoid, it's for the prepared. Dun & Bradstreet, DANB, Experian Business, and Equifax Business maintain separate scoring systems, all equally capable of judging harshly. The DANB PAYDEX score ranges from 0 to 100, with 80 as the baseline for creditworthiness. Monitoring services are typically subscription-based but invaluable. They report account activity, alert on derogatory marks, and update trade line behavior. Ignoring them is akin to ignoring smoke alarms and hoping the fire goes away. Footnote: Active monitoring of business credit ensures early detection of errors and tracks credit development. 6. Choose reported vendor accounts, Net 30. Trade credit, especially Net 30 accounts, is a cornerstone of business credit history. However, not all vendors report to bureaus. Businesses must prioritize suppliers that do, otherwise, paying on time is like applauding in the dark, impressive but unnoticed. Establish at least 5 vendor accounts that report regularly. Payment punctuality with these accounts feeds into the business credit file and affects the Paydex score. Late payments downgrade scores quickly, while on-time payments, though expected, take their sweet time to improve it. Footnote: trade lines that report payment history to credit bureaus are essential to growing credit scores. 7. Avoid common structural and financial errors. Several predictable mistakes sabotage early-stage business credit. Mixing personal and business finances tops the list. Using personal credit cards for business expenses nullifies the separation necessary for credible scoring. Another blunder: applying for credit without completing foundational steps like registration and EIN setup. Selecting the wrong entity type, such as a sole proprietorship, can limit funding access and expose personal assets. Similarly, using non-reporting vendors stalls credit progression. In essence, if a tree falls in the forest but Dun & Bradstreet doesn't log it, did it really pay on time? Footnote: avoiding structural and financial errors preserves business credibility and accelerates credit growth.